Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems for chapter 8, which are the exercises, group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that's a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, so for the first problem here, let me get my pen again. Capitalized costs for long-term assets. So specialized systems purchase land, paying $65,000 cash as a down payment and signing a $235,000 note payable for the balance. In addition, they paid delinquent property tax of $6,300, title insurance costing $2,800, and $5,500 charge for leveling the land and removing an unwanted building. The company constructed an office building on the land at a cost of $840,000. It also paid $36,000 for a fence around the property, $16,700 for a company sign near the entrance, and $7,100 for special lighting. Determine the cost of the company's land improvements, and buildings, and which of the assets will specialty depreciate. Okay, so for the land, they paid $65,000 in cash as a down payment and a $235,000 note for the balance. In addition, they had property taxes of $6,300, title insurance $2,800, and a $5,500 charge for leveling the land and removing an unwanted building. Okay, so these are all the costs that are associated with the land. All right, and so when we add that up, 816, let's see, 10, 18, 19, 24, 2, 11, $314,000. $600 is the cost of the land. Okay. Remember, it's not just land, it's the associated costs with it, which include all of those insurances and things. Right? So they construct an office building. All right. So for the building, they construct the building on the land at a cost of $840,000. Okay. It also paid for a fence. Okay, so that would be land improvements. So also paid $36,000 for a fence around the property, $16,700. $16,700 for company sign and $7,100 for special lighting around the grounds. So that's 008, 12, 19. So that's $59,800 for the land improvements. Okay, so those are the cost for the company land improvements, building, and which of the assets will specialty depreciate. Well, you don't depreciate land, right? So you're not going to do that. You're going to end up depreciating the building, and you also end up depreciating the land improvements. 33. Chance Brothers manufactures conveyor belts. Early in 2015, Chance Brothers constructed its own building at a materials, labor, and overhead cost of $940,000. Chan's paid cash for the construction cost. They also paid architect fees and building permits of $78,000. How much should Chan's brothers record as the cost of the building and record Chan's brothers transactions related to the cost of the construction of the building? Right, so let's see here. They had building of they constructed the building, materials, labor, and overhead costs of $940,000. So that was for the actual construction of the building, but they also paid architect fees and building permits, so that's $78,000. That's 811. So they ended up paying $1,018,000 in order to construct. That was the entire cost of the building. Even though architect's fees and building permits aren't part of the actual construction, they were, they were necessary in order to draw up the plans and get the permits to enable the building of the construction of the building. So they're included in the cost of the building. Record the transactions related to the construction of the building. Okay, so we're going to debit building, BLDG, for $940,000, and we're going to credit cash for the $940,000, and then for the additional $78,000, or debit building goes into the same account because it is part of the cost of that asset, right? And so we'll credit cash for $78,000. Right? So any costs that are associated with the asset that you incur in order before you put it into use ends up in the same exact general ledger account. All right, so that's why we're using building for both of those costs, for those transactions that are part of the cost of that construction of the building. Okay. Let's see, 34. It says here, Desert Sun Tanning Salon bought 3 tanning beds and a $21,000 lump sum purchase. An independent appraiser valued the beds at $9,000, $6,000, and $8,000. Okay, so that's the appraised value. They paid $1,100 in cash and signed a note for $10,000, $11,000 in cash and signed a note for $10,000. Record the purchase in the journal, identifying each tanning bed's cost by a number in a separate tanning bed account. Okay, so round decimals to 3 places. Okay, so this here is a matter of, now remember, we're paying $21,000 in a lump sum, okay? But the appraised value here ends up being $23,000, okay? So we have to take what percentage each bed is of the $23,000 and then apply it to the $21,000 to get the actual cost that we're booking as a percentage-wise for that, that we're actually paying for that. So if we have, and I'm going to do the math over here, 9,000 divided by 23,000 is 30, all right, let's do it like this. Ends up being 0.391, all right, 39.1%. 6,000 divided by 23,000 is 0.261, and 8,000 divided by 23,000 is 0.348. Okay, so now in order to double check yourself, if you add that all up, that should add up to 100% or 1. Okay, these are in decimals, right? Remember, you want to convert it to a percentage, multiply it by 100, And then you get the percentages, which ends up being 100%. But in decimal form, 1 is 100%, right? So you add those up, should end up being 1. That's the double check to make sure that you have the percentages right. So now you take since you know what the percentages are for each tanning bed, you take that particular percentage and you multiply it by what your appraised, you multiply it by your actual cost, which was 21,000, because we're looking to find what percentage of the 21,000 is that is that percentage. What percentage of that 21,000 is that particular tanning bed? In this case, we're looking at 39.1% of 21,000, which ends up being 8211, and 21,000 of 26.1% of 21,000 ends up being 5481, and 34.8% of 21,000 ends up being 7308. And if you add all of those together, you add these figures together, that should come out to your 21,000, which was your lump sum purchase, so that you know you had gotten those particular figures right. Okay. Now, it says here, record the purchase in the journal, identifying each tanning bed's cost by a number, separating tanning bed account. Right, so we're going to have a debit to tanning, and I'm just going to make it TB instead of writing out tanning bed. Okay, tanning bed 1. Now, if you were writing this in a journal, you would write out tanning bed 1, but realize that I'm just doing this for efficiency and to save some time here. Okay, so that would be my 8211. I would debit tanning bed 2 for 5481, and I would debit tanning bed 3 for 7308. So that records my tanning bed. That puts each tanning bed as a separate general ledger account on my books, and then I'm going to credit cash because I paid 11,000 in cash, and I'm going to credit a note payable for 10,000. Okay, so my debits here equal my credits here, all right, as part of that journal entry. And so that's how that's done. All right, so when you're doing the lump sum, remember you have an amount that you paid, right, which in our case was the 21,000, and then you have an appraised value, all right, or the fair market value, and you need to figure out what percentage each item is of that fair market value and apply, and that's why you're dividing, the total amount by each appraised value to come up with the percentage, which for each item, and then you take that item and you multiply it by what you actually paid. You take that percentage for each item and you multiply it by what was paid in order to know how much that particular cost, that percentage of the cost is for those items when you're looking at a lump sum. Okay. All right, so if you, that's, to me, that would seem to be relatively simple, but if you still don't understand it, go back and watch the theory videos, because I covered it there, and I went into just a little bit more explanation. And if you, so pause, rewind the videos, watch them again, read the textbook, and if you still don't understand how a lump sum gets apportioned out, then feel free to, telephone or contact an instructor, okay? All right, so I'll see you in the next video for exercise 35.